In this video, traders, we're going to look at how we can set up and frame a pair trade. I'm going to use the Nasdaq and the S&P 500 as a trade idea. Stay tuned. Hey guys, very warm welcome to you. All right, so pair trading is when we are buying one market and selling another. And why we're doing this is because we expect one of them to outperform the other. So we pick two correlated instruments or markets or stocks, and we say, hey, we think money flow is going to move from one to the other, and we're going to somewhat make ourselves a little bit more sector or market neutral by buying one and selling the other, but we're going to profit from the difference between the two diverging or converging as we have our position. So just like a currency pair. You know, when we're buying Euro USD, we're buying euros, we're selling dollars. So we're basically constructing our own artificial pair, and then we're going to artificially create that pair by buying one and selling the other independently and creating our own little pair trade. So how can we do that on TradingView, and how can we kind of decide when something might have gone too far and we think we're going to take a trade? So I'm going to use an example of S&P 500 and Nasdaq, and I'm going to do this purely because we had such an interesting situation yesterday where tech was a lot more hammered, if you like, for want of a better word, than the S&P 500. I'm going to use the ETF QQQ, and I'm going to use the SPY ETF, just so we've got a nice consistent coming from the same exchange type data on TradingView. And we can do anything, guys, by the way. You can use S&P 500 and Nasdaq. You can use DAX, CAC, FTSE DAX. You can go stock level like Uber, Lyft. Maybe you could go Twitter, Snapchat. You can kind of go as correlated as you like, or kind of change little things if you like. So you can perhaps use the supermarkets, or UK supermarkets like Tesco, Sainsbury's, etc. You get the idea. I'm going to use tech and S&P 500 here. Similar, obviously exposed to the US economy, but money seems to be flowing back and forth between the two. So I have S&P 500 here, SPY ETF, and you can see kind of from the coronavirus lows that I'm calling them, we had a good run up. If we look at the Qs, you can see that we had much more of an outperforming, and we can see that just by eyeballing the chart. And listen, the last kind of pre-election, we've had the election now, but this kind of few months before the election, we sat in a bit of a range. We did the same kind of thing with SPY. But the interesting thing is Qs never gapped up above the prior high, and they really struggled that day. And SPY did gap up, did struggle, but ultimately, you know, it's stronger. So we had a lot of money coming out of tech and into S&P 500. So how can we visualize this a little bit more clearly and construct a trade on TradingView? One way we can do this is we can first of all put SPY into a line. Let me just get rid of that drawing. All we can do is compare, and we can add symbol, and we can add the Qs directly using this add symbol button here. And it's going to then show us visually the difference between the two. Now, I always like to anchor them at a specific point. So let's anchor them because they will redraw depending on where you're putting it. So I'm going to anchor it here. I'm going to say, right, they're both about the same level here in April. Let's see what's happened. And you can see, you know, especially it was quite obvious yesterday, the difference between the S&P 500. Let's just double check what colors we've got here. So Qs is orange, S&P 500 blue. You can see the difference yesterday and where the money flow was going. And you can see very obvious times, like for example, 11th of August, you know, massive run up in tech compared to SPY, purely because of the angle. Look at the pace of that. It's just outperformed it. And I know this isn't a very logical and scientific way of doing it. We'll get to that in a moment, how we can be a little bit more scientific. We can start to visualize and see what's happening. So one thing we can do, which I've prepared already for you, and let me just kind of remove some of the bits and pieces from here. Don't get ahead of ourselves. Right, so what we can do on TradingView, which is great, is we can construct the pair just by putting in exactly what we want. So if we put in QQQ divided by SPY, what we're doing is creating a ratio chart of Qs divided by SPY, which basically says to us, what would a simple way of looking at it is, what would our equity curve look like if we bought Q and sold SPY? What's the ratio doing? So if we bought the same amount of Q and sold the same amount of SPY, what would our chart look like? And this is what we're seeing. And you can see how, you know, S&P 500 has underperformed the Nasdaq, apart from recently where we've kind of stuck in a range. And actually you can see yesterday that big spike where the ratio has gone down from 0.84 to 0.81 and a bit, just showing you, hey, interestingly, a lot of money's come away from Nasdaq. And actually, if we look and go, right, where was that level? It kind of, I think we had the 11th of August, right? If we go back and see where we had that big change where there was a big gap and then the tech just absolutely rallied, we can double check this and go, yeah, 11th of August, wow, and it rallied right up, massive outperformance from tech right until the 1st of September, which happened to be that spike, and then it kind of unwound a bit. Fine. So what we're doing now is we're creating a synthetic spread, if you like, a pairs trade of the Nasdaq and the S&P 500. And if we bought this, we're basically buying the Qs and selling the SPY. And we would normally do the same monetary amount of the two. So we'd go, okay, whatever, doing $20,000 worth of Q, $20,000 worth of SPY. Now, the advantages of this is it somewhat neutralizes you a little bit to impulsive moves in the market. If the market's all gapping up, you're going to make on the Q, you're going to lose on the SPY. But you're literally only stripping out all of that and you're trading the relationship between the two. So how would you kind of define when to go into the trade? So very often, you might say, actually, this market tends to be techs tend to be outperforming. And by the way, guys, this is just an example thesis. You will come up with your own thesis, but it's just an example. You say, okay, tech has been outperforming the Nasdaq. Nasdaq has been outperforming S&P 500. I think that's going to continue. I'm going to wait for a pullback in the trend and a mean reversion type play back up. So let's say you kind of saw this and you went, right, I want to kind of buy the Qs and sell the SPY if we go a little bit lower and get a little bit of continuation coming up the next day or the day after next day, whatever it may be. So how would you do that? So there's a couple of ways of doing it. You can kind of isolate what you're looking at and use your traditional lines. You go, right, there's my kind of midpoint of the range, if you like. There's my high of the range. And there's my low of the range, give or take. If I'm going back to kind of the middle of July, we've been in this range. And so I want to maybe buy the Qs and sell the SPY if we get to 0.8 of a ratio. So if it comes down to this sort of level here, I'll buy Qs and sell SPY, and I'll come back out here. Don't forget, you've always got to make sure you've got a stop loss in place, guys. Even though it's a ratio type trade and a pairs trade, there's still the risk that tech just completely has the money taken out of it and we go back to where we were. So you've got to manage your risk in some way. You're somewhat, risk is somewhat mitigated, but it's not eliminated. So that's one way you can do it. Another way which works very, very well is to use kind of mean reversion type indicators on your ratio chart. So stuff like Bollinger Bands work fantastically. Stick a Bollinger Band on and you're away. And this is, I think I've got my settings to 2 and 20. Fine, you can use 2.5 if you prefer. But again, this is, because it's a very mean reverting type chart. I know we've had an uptrend and we've kind of really taken off from the beginning of 2020. But if you look at the latter part here, very much in a range bound situation, using the upper Bollinger Bands and lower Bollinger Bands as guides isn't a bad way of giving you, here slightly different because you did actually go even further and you probably were stopped out on that. But, it's not a bad way of framing the trade and going, hey, you know what? We're ping-ponging back and forth, upper Bollinger, lower Bollinger, and using that as a guide. So that's one way of doing it. Another way is to use Keltner channels. I like these a little bit better, actually, than Bollinger Bands because they use ATR as opposed to standard deviation. Always want to have them on 2 style. Let's just change this so we can kind of see a bit better visually what's going on. I don't really want that a different color. I wanted that orange. Thank you. There we go. So we can see, okay, this actually holds pricing quite nicely. Again, we're using an ATR wrapped or Keltner channel wrapped around the ratio QQQ SPY, Keltner channel wrapped around that, and we're using it as a framework and go, okay, well, if our expectation is that the outperformance is going to continue, it's just a temporary pullback, we'd find a point to buy, we'd enter the trade, long Q, short SPY, and we're trying to exit on the top. Now, if our thesis was different, we thought actually it was a big rotation for the next quarter out of tech into S&P 500, and we'd take the opposite trade. We'd do the opposite thing. We'd sell our Qs and buy our SPY, assuming that we're going to S&P 500 is going to outperform. Right, one more thing. Let's just kind of put in some other stuff here. So let's say we did Uber Lyft. You can see this type of thing. Let's just remove this Keltner for now. It's the same type of thing. You can see how Uber has outperformed Lyft until very recently when Lyft has done okay. And then you can just double check this and go, all right, well, let's have a look at Lyft. Let me just get rid of this. Yeah, Lyft has shot up, and I don't know about you guys, but lines just confused me. They're fine for the ratios, obviously, but if we look at Lyft here, we've gone from 22 to 37, and Uber, much less percentage-wise, even though they've both done well. So that ratio trade that you had there has protected you somewhat from the urgent moves. Let's say if you'd shorted Uber, you're not going to get your face ripped clean off because you're going to make some money on your lift. So regardless of how you frame these up, and let's just do Tesco, Sainsbury's as well. I know those are two kind of interesting charts. Companies that are correlated, same type of thing. You can see how you can look to trade this ratio and go, oh, I think that's really too stretched. I think I'm going to sell Tesco, buy Sainsbury's. I look for a mean reversion type trade, or it's pulling back. I'm going to wait for a continuation. It just has another dimension to your trading, guys. It kind of mitigates the risk a little bit because you're not so directionally involved. You're not so exposed for directional movement. But it's something that, when you get these anomalies where you get sudden movements, perhaps where money's flowing dramatically, you can take advantage of maybe a 2 or 3 day play, say, oh, I think that's really too much. A lot of money's come out of tech, or a lot of money seems to have come out of one of those companies, which doesn't make much sense because they're very, very similar, and trading the supply-demand imbalance coming back in to a line, or what you consider into line. So anyway, guys, and also one thing to point out, very often you get this scenario where, and these are probably the better conditions if you want to trade mean reversion. For a whole year, you'll get the markets where they just sit and they ping pong back and forth, two correlated markets. Trading a Bollinger Band type thing. We'll just put this in, guys, and then we'll call it a day on the video. Just putting a Bollinger Band around that and going, right, well, I'm just going to trade the Bollinger Band. We're not doing much in this time period. There's not a lot going on. There's no real catalyst to move these one way or another. They're just both supermarkets operating in the same geographical area, in the same sector, selling the same goods effectively. Let me just trade the money flow back and forth. And I know people who do that very successfully. It's not that exciting. If you want excitement, maybe you want to start scalping the DAX or crude oil instead. But it's something to think about as maybe another way to express your trade idea. And guys, if you like this kind of stuff, thumbs up is appreciated. Don't forget to check out our channel sponsor, as a link to the description below. And by the way, if you've got any ideas on pairs that you're watching or you've traded, you're specifically interested in, let me know in the description below, because sometimes they don't flag up in your screening, you don't think of them, and this is a great way of kind of sharing ideas as well. Take care, guys. Bye bye.